Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're starting with some significant news from the mortgage industry. Ontario's Financial Services Regulatory Authority, or FSRA, has suspended ZK Financial Inc. DS mortgage brokerage license for 2 months and fined its principal broker, Renkai Lin, $6,000. This action comes after FSRA discovered that Lin provided false or misleading information to the regulator.
That's quite a serious development, Steve. It seems that the FSRA is taking a firm stance on ensuring transparency and honesty in the industry, which is crucial for maintaining trust with clients and the public.
Absolutely, Janine. According to the FSRA, Lin violated subsection 45(1) of the Mortgage Brokerages, Lenders and Administrators Act, 2006, by giving inaccurate information. It appears he failed to disclose criminal charges when submitting individual mortgage agent license applications in both 2023 and 2024. This lack of disclosure was a significant factor in FSRA's decision.
It's disheartening to hear about such oversights, especially when the repercussions can affect so many. Lin's case highlights the importance of full transparency and accountability in the licensing process. It's not just about following the rules, but also about maintaining the integrity of the profession.
Exactly, Janine. Lin's failure to disclose his charges under the Criminal Code of Canada, which were laid back in June 2022, and his subsequent court appearance in August 2022 were critical missteps. He falsely answered no to a required disclosure question on his license applications, which is a clear violation.
And it seems this wasn't a one-time oversight. FSRA also cited Lin for making false declarations in 2 consecutive annual information returns filed on behalf of ZK Financial. Even with his pending criminal case, he again answered no to whether the brokerage or any of its directors were subject to any charges.
That's right, Janine. These annual information returns are crucial as they ensure regulatory bodies have accurate information about the entities they oversee. Lin's repeated false affirmations were a breach of trust and demonstrated a lack of compliance with regulatory requirements.
It's a reminder to all in the industry about the importance of honesty and transparency. The FSRA's actions serve as a warning that misleading the regulator can have severe consequences. It's about protecting the industry's integrity and the clients we serve.
Definitely, Janine. Maintaining the trust of both regulators and clients is paramount. As we move forward, it's crucial for all professionals in the industry to adhere strictly to ethical standards and regulatory requirements. Let's continue to discuss how these developments affect the broader market in our next segment. Let's dive into the current trend where mortgage borrowers are increasingly opting for variable rates amid an uncertain economic outlook. Canada's National Housing Agency recently confirmed that variable rate mortgages have become the most popular choice across the nation, surpassing fixed-rate products. This shift follows a series of rate cuts by the Bank of Canada last year.
It's fascinating to see this move, Steve. 42% of new mortgages were on variable rates by February, according to the Canada Mortgage and Housing Corporation. This change is quite significant, especially considering how borrowers were steering clear of variable rates during the central bank rate hikes in 2022 and 2023.
Absolutely, Janine. The Bank of Canada executed 7 consecutive rate cuts last year into early 2025, and the expectation of further reductions seems to have bolstered confidence in variable rates. Borrowers seem to be betting on the continuing trend of rate cuts, hoping to benefit from lower payments.
However, it's not just about the rate cuts, Steve. The unpredictability of the 5-year Government of Canada bond yields, which heavily influence fixed mortgage rates, is also playing a role. Bond yields have been fluctuating unpredictably, and many experts, like financial advisor Justin Prasad, are skeptical about any significant drops in fixed rates soon.
That's a good point, Janine. The bond yields have indeed been creeping up, causing some fixed mortgage rates to increase in recent weeks. Prasad mentioned that the current economic landscape is making borrowers reconsider their options, with variable rates looking more appealing given the uncertainty over fixed rates.
And it's not just about the rates. The overall economic outlook is adding another layer of complexity. The CMHC has highlighted that the biggest risk to the residential mortgage market is the economy itself, especially with unemployment potentially impacting mortgage defaults.
Yes, the trade war, initiated by the United States this year, has added to the economic uncertainty. It's putting pressure on inflation and raising concerns about job security in Canada. This situation is likely to influence the Bank of Canada's future decisions, possibly leading to more rate cuts as early as September.
Justin Prasad even mentioned the hope for another 50 basis points in cuts by the end of the year. There's a belief that the 5-year fixed rates might hover just above 4%, while variable rates could present an opportunity to switch to fixed if they drop further. It's a strategic decision for borrowers, considering the potential for rates to go even lower.
Indeed, Janine. The uncertainty surrounding the economy and the ongoing trade negotiations between the US and Canada are making borrowers cautious. While some progress has been reported, a final deal seems distant. The prospect of a weaker economy and job losses is causing potential homebuyers to pause and reassess their options.
It's a challenging time, Steve. There's a lot of mixed signals out there, and as Prasad pointed out, it might take until the fall to gain a clearer understanding of where the economy and the Bank of Canada's policies are headed. Until then, borrowers will need to navigate through the noise and make informed choices.
Now let's turn our attention to the bond market, where we've seen a notable development. The yield on the Canadian 10-year government bond has climbed to around 3.4%, marking a 5-month high. This increase is being driven by more hawkish expectations for the Bank of Canada, as well as ongoing geopolitical tensions.
That's right, Steve. The persistent core inflation readings in Canada have been above the Bank of Canada's 2% target, and this has been a significant factor in shaping these expectations. Plus, we saw an unexpected 1.2% jump in April retail sales, which has reinforced the belief that the bank's policy will remain restrictive.
Exactly, Janine. The demand for higher term premia is becoming evident as investors adjust to these market conditions. Ottawa's long-term financing needs are considerable, and this has led to an increase in benchmark issuance. At the same time, traditional buyers, such as pension funds, are looking abroad for richer yields, which adds another layer of complexity to the situation.
It seems like the external factors are also playing a crucial role here, Steve. A broad upswing in global interest rates, fueled by strong economic data from the United States, along with renewed trade tensions and ongoing geopolitical uncertainty, has been influencing Canadian yields. This global backdrop is certainly impacting borrowing costs, keeping them anchored near multi-month peaks.
Indeed, Janine, the interaction between domestic economic indicators and international developments is creating a challenging environment for borrowers. As the yields rise, it becomes more expensive for the government to finance its debt, which can have broader implications for the economy. It's essential for investors and policymakers to keep a close watch on these dynamics as they evolve.
Absolutely, Steve. While the rising yields present challenges, they also reflect the robust economic data and the resilience of the market. It's a reminder that even amid uncertainty, there are opportunities for strategic investments. Borrowers need to be mindful of these changes and consider how they might impact their financial plans moving forward.
Let's discuss the recent data on Canadian housing starts, which remained relatively flat in May after a significant surge in April. The seasonally adjusted annual rate saw a minor drop of 0.2%. This comes as markets in Ontario and British Columbia continue to show signs of weakening.
It's interesting, Steve, because while the numbers were flat, there's a broader story here. The 6-month trend actually posted a slight increase of 0.8%, and year-over-year actual housing starts grew by 9%. So there's some underlying growth despite the monthly fluctuations.
You're right, Janine. The data from the Canada Mortgage and Housing Corporation highlights that May was less active compared to April, which was an outlier with record high starts. Desjardins economist Carrie Norman points out that April's numbers were more about reporting fluctuations rather than a genuine sector turnaround.
Exactly, Steve. And if we look at the regions, Quebec and the prairie provinces like Manitoba and Saskatchewan showed impressive growth in housing starts, with increases over 200%. Meanwhile, Toronto and Vancouver are seeing declines, particularly in the multi-unit sector, due to weak condominium market conditions.
Right, the condo markets in Toronto and Vancouver are really under pressure. Sales have plummeted, inventories are ballooning, and prices have dropped significantly since 2022. This has led to increased project cancellations and a downtrend in multi-unit starts. It's a challenging environment for developers in these cities.
It is challenging, and it's impacting the broader housing market in Ontario. With construction costs high and sales weak, housing starts in the province have dropped over 20% compared to the end of 2024. This marks the lowest level since 2009, according to the Financial Accountability Office of Ontario.
That's a significant drop, Janine. The affordability challenges that households are facing are a major factor here. High construction costs and weak demand are creating a bottleneck in the market. It's a tough time for the housing sector, especially in Ontario and British Columbia.
Yes, and it's not just about the numbers. These trends have real implications for families and individuals looking for affordable housing. It highlights the need for strategic policy interventions to address these challenges and support the housing market's recovery.
Let's take a look at the recent sale of a condo in Toronto that highlights the current challenges in the real estate market. A unit at 28 Wellesley Street East sold for a significant loss of $143,000. Originally purchased for $591,000 in January 2020, it was recently listed for $499,000 and sold for $448,000 in early June.
That's a substantial loss, Steve. It's disheartening to see homeowners having to sell at a loss, especially when they purchase during the peak market years. The Greater Toronto Area has seen a decrease in average home prices, which are now down by 4% compared to May 2024. This situation is tough for those who bought at high prices during 2022 and 2023.
Indeed, Janine, it's a reflection of the broader economic challenges and market conditions. Jason Mercer, the Chief Information Officer at the Toronto Regional Real Estate Board, pointed out that the current lack of economic confidence is a significant factor. The ongoing trade instability with the United States is making homeowners cautious, and this uncertainty is impacting the real estate market.
And it's not just houses. The condo market is also feeling the pressure. The average condo price in the Greater Toronto Area is down by 6.4%, and sales have declined by over 25% year over year. This slowdown might force some homeowners to accept lower offers than they initially anticipated.
Right, Janine. The condo at 28 Wellesley Street East is a prime example. Despite its attractive features like floor-to-ceiling windows and a modern kitchen, the unit sold for significantly less than its purchase price. This trend is indicative of the broader market conditions where sellers are often compelled to take a hit to move their properties.
It's a challenging time for both buyers and sellers. For sellers, accepting a lower price can be a difficult decision, especially when it means incurring a loss. For buyers, however, it might present an opportunity to purchase properties at more affordable prices. It's a complex situation that requires careful consideration of the market trends and economic indicators.
Absolutely, Janine. While this is a tough period for many homeowners, it's essential to remain informed and strategic about real estate decisions. The market is cyclical, and understanding the factors at play can help individuals navigate these challenging times. It's crucial for both buyers and sellers to stay updated with the latest developments and adjust their strategies accordingly. Let's shift our focus to a unique solution for self-employed borrowers in Canada. We're seeing a growing number of individuals who, despite having a strong financial profile, are struggling to secure mortgages due to non-traditional income documentation. This is where Neighbourhood Holdings' self-declared income program comes into play, offering a flexible approach to mortgage approval.
That's right, Steve. It's a common issue for self-employed Canadians who have excellent credit and a solid down payment, but face rejection from traditional lenders because their income doesn't fit the standard documentation mold. Many entrepreneurs and freelancers earn irregular incomes, and traditional lenders often overlook their actual financial strength.
Exactly, Janine. The traditional lending models rely heavily on documents like T4s and notices of assessment, which don't always accurately reflect the financial reality for self-employed individuals. Neighbourhood Holdings addresses this gap by focusing on the bigger picture rather than just ticking boxes.
And that's crucial, Steve. Neighbourhood Holdings uses a thoughtful case-by-case analysis that respects both the borrower's story and the lender's responsibilities. It's about understanding the borrower's business model and life stage to determine if the declared income makes sense.
Indeed, Janine. This approach not only provides flexibility, but also ensures that the mortgage process remains responsible and logical. By asking the right questions and understanding the borrower's full financial picture, brokers can submit stronger applications and help clients move forward with their homeownership goals.
It's about bridging the gap between strong borrowers and rigid underwriting frameworks, Steve. With the self-declared income program, brokers are empowered to say yes more often, helping clients who deserve a shot at homeownership. It's a more human lens on the mortgage process, something that's increasingly needed in today's diverse economic environment.
Absolutely, Janine. This program is a testament to the evolving mortgage landscape in Canada, where flexibility and common sense are becoming more crucial than ever. For self-employed borrowers, it means there's a viable path forward, even when traditional routes are closed off.
It's encouraging to see lenders like Neighbourhood Holdings stepping up to meet the needs of a changing workforce. By understanding the unique challenges faced by self-employed individuals, they're helping more Canadians access homeownership and wealth-building opportunities.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.